Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us on this Holy Week version of the Market Carver. We got just a couple of points to you. Again, keep it light here and hope to see most of you as we enter thirdly season, beginning in early April and then going on over the next couple of weeks. So looking forward to seeing several of you that I know do both, listen to these market covers and come to the third league. So we're going to talk about U.S. economic performance relative to the rest of the world, and then Andrew's going to dive into relative strength. But first, before I get into the economic stuff, last week we previewed the Federal Reserve meeting. I don't have a chart or anything for that, just because it's a quick, simple update. Really, the only thing that was going to be of significance for the Federal Reserve is whether or not they were going to stick to their forecast of 3 rate cuts during this year. And some were looking for that maybe being dialed back to 2. And they stayed with 3 for right now. So they are very so close. All they need is really one member to change his mind or her mind from 3 to 2. And then all of a sudden the average or the projected average forecast by the Fed comes back to 2. So nothing really significant there other than the rest of the world, except for Japan, has been moving towards rate cuts, and then all signs point to eventually us joining them in the rate cut regime. And that is despite what has been strong economic performance here in the United States. This is a chart over the past year. The black is the United States. The other colors are other developed countries, the Eurozone, Japan, etc. And as we've seen year after year after year, the U.S. continues to lead in terms of economic strength. In fact, you can see really a strong divergence this time from the rest of the world. We're looking more like the average 2 to 3%, while the rest of the developed world stuck in much more sluggish growth. So it is easier for those other central banks to go cuts with that weaker economic performance. But when you have so many of them cutting rates, it'll be difficult for the Fed to hold out. Otherwise, they risk having dramatically higher rates than the rest of the world, and that puts pressure on the United States dollar and can cause its own challenges. So that's another element of that rate hike that we'll be paying attention to. So that's what I have on the economy. I'll pass it over to Andrew to take a look at the current sectors.
All right, thank you, Adam. So this week we're going to take a step back. Instead of looking at just the major indexes, which has been a popular topic in our allocation meeting and on this market cover, we're now going to shift towards a little bit looking at these sectors. Now, we have 11 primary sectors. We call them S&P 11, as these are the primary sectors that we're looking at as we divide up the market. And each company that's in the S&P 500 is categorized in one of these 11 sectors. Many of them are going to sound familiar to you: technology, energy, financial, communications, industrials. Obviously, often similar different parts of the economy as well. But here we're just looking at the market. And why this is important and what this chart is showing is the relative trends of these sectors relative to the market. If each one of these lines is going higher, that means it's outperforming the broad market. So we can use technology, for example. Its trend has slowly been going from the bottom left to the upper right as technology stocks have done very well. Meanwhile, if you look at the bottom part, look at real estate, it's kind of the opposite. It's trending lower, meaning it's underperforming the market. And why we want to look at these types of relative trends is it tells us where is the market, where are traders focusing their bullishness? Where are they buying? Where are they looking for outperformance in different sectors? And when we looking for the more offensive sectors, the more risky sectors, technology, energy, communications, typically areas that do well when the economy is also doing well, these are positive signs that the market is staying more on an offensive and bullish bias. Now, when things start to reverse like they did during more downturn periods, during the financial crisis, or here more recently, just looking at 2021, 2022, we start seeing defensive sectors start to outperform. Healthcare, utilities, consumer staples, less risky, lower, less volatile areas of the market start to do better. And so when we start to look at which area, defensive or offensive sectors, are doing the best, it can tell us if the market is leaning more offensive or defensive itself. And so I put green boxes around the ones that are starting to trend higher or have had a good trend for the last several weeks or months. And then there's a red box around the ones that are trending lower. And the commonality we see here is the majority of the trends that are moving higher are more offensive sectors. Again, energy, financials, material, industrials, technology, these all areas of the market either for a longer period or more recently are starting to show outperformance relative to the market. Meanwhile, those defensive sectors, consumer discretionary, healthcare, utilities, those are the ones that are starting to hit 52-week lows relative to the market. The only kind of standout here is if you look at consumer discretionary, this is stocks like Amazon, Tesla, things that a lot of consumer type goods. These stocks actually have not been doing as well. This is largely due to the trend we're seeing in Tesla. It's starting to struggle and has a very large weighting in consumer discretionary. This would be more of the offensive sector, but it's struggling. So we can't always have it perfectly where every offensive sector is doing well together and all the defensive aren't. But from the majority of viewpoint, we are seeing defensive sectors are the ones underperforming and offensive sectors are the ones outperforming. And from a market standpoint, that's a positive bullish sign that investors are starting to chase after, continuing to chase after those more offensive, bullish, riskier areas of the market. And so this is a positive for the market as a whole.
That is great, Andrew. I really appreciated this when you shared it with us yesterday, and just even more color today as we look at those sectors. So appreciate that, and appreciate all of you giving us your attention here as we head into an important weekend, honoring Good Friday and celebrating Resurrection Day. So for those of all of you who will be celebrating, hope you have a wonderful weekend. As always, give you a reminder. Give us a call, 800-928-4001, or book electronically there with the QR code. Thanks again. We'll see you next week.